And so here's another way, a slide I like to really simplify the classification. So if we have a balance sheet, current assets and current liabilities are almost always operating activities. Plant assets, any long-term asset is investment activities, and any long-term liabilities are equity or financing activities. This is the easiest way to classify it. There's nuances and complexities you get when you get more complex transactions, but for this class, this is the way I want you to think. So let's go through some examples. Operating activities. You have to memorize these examples, but also understand the logic. Cash sales to customers, collection on credit sales, receipt of interest revenue. So first thing to realize, right, these are whenever we're debiting or crediting cash, right? Cash inflows is when we're debiting cash. Cash is increasing. Cash increases, right? What's that? We should know the journal entries for this. We debit cash and credit revenue. That's going to increase our cash flows. For collection on credit sales, we debit cash and credit AR. Receipt of interest revenue, we debit cash and credit interest receivable, right? Debiting cash in all of these. For cash outflows, it's our credits to cash. Paying suppliers for goods or services, debit expense, credit cash. Paying interest owed, debit accounts payable or interest payable, credit cash. Paying salaries, debit interest, salaries expense, credit cash. Taxes, tax expense, credit cash. Operating expenses, debit OPEX, credit cash, right? All credits to cash, all debits to cash. That's going to be true for all of these, but note that these are for the short-term obligations. Investment activities, same thing. All these are credits to cash, but then these are debits to long-term assets like plant, property, and equipment, long-term investments, principal on notes, collecting principal on notes receivable, selling of long-term notes receivable. All these are related to long-term assets. Notice this is the principal, not the interest, right? We're collecting the principal back. The interest is generally an operating activity, and there's debates on this and actually more recent guidance, but I don't want to go into that in this level of class. Cash outflows, when we're buying long-term investments, when we're buying PP&E, when we're loaning money in return for long-term notes receivable. Right, when we're loaning it. If we're the borrower, then we're financing activities, right? When we're loaning it, it's a long-term notes receivable. When we're borrowing, it's a notes payable. And so examples of cash inflows, again, here you can think debit cash, credit equity, debit cash, credit treasury stock, debit cash, credit our long-term debt, contributions by owners. Outflows, we're talking about paying off long-term debts, purchasing treasury stock, paying withdrawals to owners, paying dividends to shareholders, right? All of that, what is the common theme here? It's related to our long-term liabilities or equity. And this last piece is we need to disclose non-cash activities, significant non-cash activities. And so that's added to the statement of cash flows. There's some things we do where we don't pay in cash. And so it's not going to show up on the statement of cash flows directly to any of these. It's not going to belong to any of these buckets. So what do? We have to disclose it as non-cash activities. What are examples of this? What if we use debt to issue stock or pay off debt with the issuance of stock? So one of our banks decides to convert some of their debt to stock. Well, there's no cash flow there. We just don't owe the debt, but now we have more equity partners. So we have to disclose that on the statement of cash flows. What if we convert preferred stock to common stock? Or what if we purchase long-term assets in exchange for debt? Or what if we exchange non-cash cash assets for other assets? What if you give me a piece of land for my building? The key one, a lot of these are pretty uncommon for most businesses, but the most common is what if we dispose of assets? Like if I decide a series of trucks I have are no longer useful or inventory is obsolete, I don't get cash for that, and it's written off my balance sheet. I have to disclose that as a non-cash activity. So let's kind of go through this practice, and let's just say it out loud for whoever has it. So where would this be classified? Received cash interest on a notes receivable.
Operating activity.
Operating, perfect. And why is it operating?
Because it's cash activities, so sales, accounts receivable, stuff like
Exactly. It's a
that.
short-term activity, right? Even though it's the note receivable is long-term, the interest receivable is short-term. And so that would be
Wouldn't note receivable usually be like 2 to 3 months, right?
short-term is less than a year.
Oh, okay.
Yeah,
All
yeah.
right. Thank you.
No problem. What about cash payments from a customer?
Operating activity.
Yep. Because, right, that's short-term.
Yeah.
Operating, even if it's accounts receivable collections, right, that's short-term. Well, someone else try now. Saeed, that's good. Paid cash for wages and salaries.
Also operating?
Yep. Why?
That would also be in the short term since you're just paying people on an almost constant basis.
Exactly. And it's tied to net income, right? So it's perfect. Those are two ways to think of it. What about purchasing inventory for cash?
Operating,
Yep. Why?
it will not debit for cash, but it's an outflow.
Yeah. You're thinking about it right because it's tied to cash, and inventory is a short-term asset, right? So instead of hitting net income directly, we're capitalizing it. That's correct. How about cash dividends? Anybody?
Financing. Yeah, operating and financing activities.
Yeah, financing, correct. Why is it financing?
Because issuing common stocks is part of the cash inflow.
Oh, sorry, we're talking about dividends here, not the issuance.
Oh yeah, so it's like yeah, it's paying cash dividends as part of the cash outflow. Sorry.
Yeah, outflow, and it's reducing equity, right? Because dividends reduces equity. Equity is tied to financing activities, so it's a financing activity. You're thinking about it right. Common stock for cash.
Financing?
Correct, financing. Because it's tied to equity, right? So is that making sense? Yeah, but it's tied to equity. What about paid cash interest on outstanding notes payable? Oh yeah, you guys are you're all getting it. I'll walk through it. So we paid cash on outstanding interest is we're talking about operating, right? Because it's related to the interest payment, and that's where it's complex. It's not the notes payable. The principal is long term, so that's where we would have to be it's a financing activity. But the interest, it's operating because interest is short term. We have interest payable and interest receivable is short term. Received cash from the sale of land at a loss. These are two components, right? This is pretty complex, but I think we should all get there now. If we received cash for the sale of land is an investing activity, right? That's a long-term asset. But if we sold it at a loss, the loss portion is an operating activity because it immediately impacts our net income. What if we issue debt in exchange for land? We're talking about non-cash transaction, right? There's debt and land. There's no cash in there. So that would be just a non-cash transaction, and we would disclose it. And then lastly, sold long-term investments for cash. It's because they're investments. Investments are a long-term asset. And so because it's for cash and if there's no gain or loss, it's an investing activity. And ultimately, this is what we would get. We'd get a cash flows from operating activities, from investing activities, from financing activities, and then we'd have a net increase or decrease in cash, and then that would reconcile to the cash on our balance sheet. It would be the same number at the end. And this would just explain how that cash moved from the beginning of the year to the end of the year. So this is really what I want you to take away. But part of your homework is also going to be calculating these numbers. And so that's why I'm going to go back to the book slides. But I want to make sure, do these overarching concepts make sense? Is there any questions?